So far from chapter 2, we saw the two type of investments that we have. Those are the short-term investments. One was investments when we don't have significant influence. Means the general rule is 20%, but not necessarily. Sometimes with less than 20%, you may have a significant influence. Sometimes with more than 20%, you still cannot have a significant influence. It depends. That's a general rule, but they also take a look at the case facts. So for those one who we don't have a significant influence, we're using cost method, and for the reporting, we're using fair value through profit and loss or fair value through other comprehensive income. For the short-term investments, which we just no significant influence, the one that we just keeping for the fluctuation of the market price, we using the fair value through profit and loss. For the other one, through the other comprehensive income, we have to check with the management what's their intention to those investments. If the intention is to hold the investments for more than one period, then we can go with the fair value through other comprehensive income. The difference is the way you're showing the fluctuation of the investment. If there are any unrealized gain and losses, where exactly those are reported, are they reported directly on the current income or to the directly into the retained earnings as an item of the comprehensive income related to those one. Obviously, the preferable depends how it is. The preferable will be to directly to the comprehensive income because that's not going to affect the earnings per shares. That's the only thing. And again, don't forget here, we're talking about only for the public companies. Private companies are not subject to this chapter. Now, once we do those, the other type of investment was significant influence. For significant influence, we're using equity method. Now, for the equity method, every time when we receive the dividend reducing the investment, and when the other company shows the net income, a part of that income belongs to us since we have a percentage which is more than 20%. That percentage of the income is going to increase our investment on the other side, and that's going to increase the investment income from the company that we have significant influence. That will be the implication. Compared to the non-significant influence, income comes from the dividend. And every time when the reporting period, we have to compare where the market value is to adjust the investment to the fair market value. Where in the equity method, we don't have to do that because the ending balance always reflects what exactly is the balance in our investment. So now let's move to the next type of investment, which is a business combination. Now, in order to be a business combination, then one company has to acquire another company or business. Obtain control of one or more businesses. So that will be the pure definition of business combination. Happen when one company acquire or obtain control over one or more businesses. And that's discussed in the International Financial Reporting Standard 3. Now, what's the reason for the business combination? It can be different. It can be because we want to defend our competitive position on the market, or because we want to diversify it, or want to expand to the new markets, or because we want to have access to the new customers, products or services, or expertise or capabilities, whatever you want to do, or we want to access the technology. That's why probably Facebook purchased WhatsApp. That's why we're seeing all those mergers, because the big companies or the one that have more money see something in the small that they have, either technology, either clients, either reputation, and they want to get those one to obtain the control. So they just want to acquire that business. When the business combination happens, then we have to prepare consolidated financial statements, which are required for the report of the combined financial position. And now we're going to have the terms, which is one term is the parent and the other one will be subsidiary. The parent will be the one who have the control, subsidiary that is being controlled by the parent. Now, the business combination, which is defined in International Financial Reporting Standard 3 as a transaction or event in which acquire obtain control over one or more businesses. There are two aspects here. So now, if this one happened into the CPA case, you have to prove two things. First, you have to prove that this is actually a business. And second, you have to prove that there's a control. So there are two aspects here that you have to chase. First one is the business, second one is control. Now, what is business? Business, it will be defined in the International Financial Reporting Standard 3 as an integrated set of activities and assets that can be conducted and managed for the purpose of providing a return in form of dividend, one, lower cost, second, or other economic benefits which can go directly to the investor or other owners, members, or participants. So this is pure definition of business. Again, integrated set of activities and assets which are managed for the purpose providing a return. Now, what form of the return will be that can be dividend or lower cost or other economic benefits. To whom? To the investors or to the other members and participants. Now, the business consists inputs and processes. And those apply to have ability to create the outputs. So once we have the inputs and processes, the business, in order to be business, has to provide the ability to create outputs. Outputs in form of return, right? What will be the return? Can be dividend, can be lower cost, and other forms of. So that will be the one thing. So the buying a group of assets, however, it doesn't mean that you're buying business. So you can buy a group of assets, but it doesn't mean not necessarily means that you're buying business. Control. So now once we establish what the business is, now we have to establish what the control is. Now the control is the power to direct the relevant activity of the investee. Control also requires the investor has exposure or rights to variable returns, which involved in from the involvement in the investee, and has ability to use the power to affect the amounts of the investor return. So basically, in this case, the control means that you have power to control what the other entity is going to give you back as a return. So if you have means control, that means you're presented on the other company, and once you see the other company has some money, you can say, I want dividend, and you're declaring yourself a dividend, which dividend you're getting as a parent. That means control. Purely, you have ability to control the other company returns. Owning more than 50% of the voting shares usually give you the control or indicates the control, but not necessarily. Control can be present with less than 50% of the voting shares, but only if other factors indicate control. So basically, let's say the company has 45% of the voting shares with another company, plus irrevocable agreement with the other shareholders to convey voting rights to the parent. So all the other shareholders give you all the rights, you to vote and accept whatever you want. In that case, with the less than 50%, you can say I have a control. Or if the parent holding rights, warrants, and convertible debt, which when is converted or exercised, give you more than 50%. So basically, I have 45% of the voting share of the company, plus I have a bonds, which are convertible into the common shares, which bond, if I convert it, I'm going to have more than 50% of the shares. In that case, I can say that I have a control. And the other one is I have a control, even though I don't have it, but there's a contractual agreement that can give me that control. What will be that? Simple thing is, the simple example that I can use here is the purely the mortgage. We have the owner of the house, which have outstanding mortgage with the bank. Now the question is, does the bank have control over the property? Technically, it does. Why? Because if there's a contractual agreement that if the person who borrowed the money does not make the payments when they have to make the payments, the bank can take control over the property. So that's will be contractual agreement that gives the control to the bank. That's a simple example with that, but we can transfer it to the business. Now, the other thing that we can talk about a dim control. Dim control is when the other shareholders not actively cooperate when they're expressing their votes. So you're going to the shareholders meeting and you're the only one there. There's nobody there. Example will be another company. One company may own the largest single block of shares with another company. Let's say X owns 40% of the company, while the 60% are widely spread. So that means there's not concentrated in one. They're always like a spread everywhere. And then as a result, the company that owns 40% has no problem to elect the majority of the directors. That company also can be seen as they having the control in this situation as long as the other shareholders don't actively cooperate against the company X when they're voting their shares. Control and consolidation would stop once the parent lose that control. And the example will be, for example, the majority of subsidiary assets are seized in a receivership or the bankruptcy situation, and that will be another case that control is going to stop. Normal business restriction do not stop the control by the parent. You may have some business restrictions like a tariff, which is imposed now on the Canadian company, but that doesn't stop the control. So the existence of the certain protective rights, which are held by the parties, does not necessarily provide those parties with control. This is a case when some party can have some rights, but doesn't mean that they have a control. So which one will be that? Approval of veto rights that don't affect the strategic operating and financing policies. So basically, you have a veto rights, but that doesn't apply to anything major. The other thing is ability to remove the party that directs the activity of the entity in the circumstances of bankruptcy or the breach of contract in that party. So as you can see here, yes, you can remove that party, but you still don't have access to the earnings or returns which are generating to the company. So in that case, a control won't exist. Certain limitation, the other example will be certain limited operating activities of the entity, such as pricing or advertising limitation, typically placed by the franchisor franchisee. So that the franchisor in this case have a control over the entity? No, he doesn't. So this is the instances when you may think that there's a control, but there's no control. So the parent can control subsidiary even though other parties have protective rights related to the subsidiary. So you may have that control even though the bank is protected by some assets or some accounts receivables. Now the bank will be protected, but you still have control over the subsidiary. And the key aspect of control is ability. Again, the key active, I want you to understand this. The control is the ability to direct the activity which most significantly affect the return. If you can affect the return and activity related about the return, you have the control. There are three main forms of business combination. So now let's see what kind of forms of business combination we may have. One is to purchase the net assets. Once we purchase the net assets of the company, that means the company stops existing. Simple. The other one is to acquire enough shares of the voting shares of the company to use the net assets. And the last one is to gain control to the contractual agreement. That's the third form, which is contractual agreement. Again, in that case, just think about the mortgage. Right? Bank doesn't have to buy the house. The bank doesn't have to own the share of the person who have the house in possession right now. Just the person have to not to meet the requirements by the contract, and the bank can become the owner of the house. That's another way to express control. So different ways have different implications. Let's say go with the purchase of the assets or net assets. So when we're purchasing the net assets, transaction is carried out in the selling company. So who's doing the do we have to do consolidation in this case? That will be hard to tell, most likely no. Why? Because we're just purchasing the assets, we're putting the assets in our books, the other entity disappears completely, so it doesn't exist anymore. So there will be no reason for any consolidation this one. Second option is to purchase the shares. This is alternative of the purchase the assets. Is when the acquirer purchases non-voting shares from the shareholder. Shareholders acquiree that can determine the acquiree strategic operating financial policy. When this happens, the transaction usually is consummated with the shareholders of the selling company. The acquired company make no journal entries in this case. So what that means is this. Means simple this. Imagine I have my own company, right? I have my own company. And you're coming and you don't want to buy the assets of the company. You want to buy my shares of the company, and you want to buy all of the shares. Let's say I have 2 shares, and I'm telling you, okay, pay me $2 million for my shares, and I'm going to give you the shares. So you're paying me $2 million for the shares. The question is, how much of those $2 million is going to go into the company? And the answer is 0. Why? Because that's transaction from the purchasing and buying of shares. It doesn't happen on the level of the company. It happens on the level of the shareholders. which shareholders are third parties in this case. There's not involvement in the company. So the company from this transaction is going to get zero. So that's for that reason, there's no journal entry which is related to the acquiring, buying and selling the shares between the two shareholders. That's not on the books of the either company. Compared to if the company purchased the net assets, in that case, yes, the net assets should be, all the transactions going to happen in the books of the buying company in this case. The last one was less control through the contractual agreement, and that can be get for when we have the contractor, which doesn't involve any buying of assets or buying of shares. The company just get the company is transferred from one share to one person to another person, one party to another party, and that's all. So let's see forms of the business combination. There are three forms of the business combination that result in asset and liability of the combined company to be those asset liability to be combined. If the control is achieved with the purchase of the net assets, the combining take place in the accounting records of the acquirer. So basically, the one who purchased the assets, getting the assets and putting the assets in his books. Again, the other company does. If the control is achieved by the purchasing of shares to the contractual agreement, combining taking place in the consolidated financial statements, and then the consolidated statements are prepared, if that happens. Now, the three main different legal forms, there are many different legal forms which the business combination can be consummated, and the statutory amalgamation happen when two or more companies combine a form of the single legal entity that will be amalgamation between the two companies, which become a one company later. So, business combination, how we're going to count the business combination? We're going to have under the acquisition method. So, International Financial Reporting Standards outline the accounting requirements for business combination. The main principle here is all businesses combinations should be accounted for by applying the acquisition method. What that means, acquirer should be identified in all the business combinations. So when we have a business combination, first thing that we have to do is we have to identify who is the company that acquires first. Second, the acquisition date, which is the date that the acquirer obtained control of the quarry. The acquirer should attempt to measure, now the acquirer again should attempt to measure the fair value of the quarry as a whole, the entire fair value, at the acquisition date. The acquirer should recognize also and measure the identifiable assets. So basically we're getting the company, the other company as a whole, and then we're going to the individual assets level and try to measure all the individual assets and liabilities, which we assume are the fair value, and report separately the goodwill. So now, what I want you to understand is, since we're talking about the net assets, from the accounting equation, we have assets equal to liability plus equity. So the net assets are technically the equity. We're not going to talk about equity, but we're talking about the net assets. Well, the assets minus liability give you the net assets, which indirectly is equal to the equity. So what the acquirer purchased, they indirectly purchased the equity. But how they purchase it? By buying the assets and buying the liability. So for that reason, all the assets and liability, you have to come up with the fair market value. And if there's any difference, we're going to recognize it as a goodwill. So, acquisition cost measured at the fair value of the consideration given. Now, acquisition cost will be the measure at the fair value of the consideration given, that means how much the other company pay to acquire business. Is made of the following. First, so what will be the consideration? Consideration first will be the cash paid. Second, fair value of the asset transfer by the acquirer. The acquirer may transfer some assets to acquiree. Present value of the any promises by the acquirer to pay cash in the future. So if there's any payment that the acquirer have to pay in the future, those we're taking the present value and we account for that present value as well. The next one is the fair value of the any share issued. So if there any share issued, the value of the shares is based on the market price and has to be recorded as well. And the last one is the if there any contingent consideration, which has to be any contingency. That means any thing that may happen or may not happen in the future. If that happen, we have to measure it. Simple will be like this. Imagine this. Let's move from the business combination here in the finance world into the sports. Imagine this. I'm buying, let's say, I'm making contract with, I don't know, some soccer player which is famous right now. I don't even know the names now of the soccer player, but let's say long time ago with Ronaldo. I'm making contract with Ronaldo. Original contract amount is for $50 million. Plus, $2 million bonuses for every completed year for the next 2 years. So every year the contract is for 5 years, $50 million for 5 years, and at the end of every year he gets another $2 million. Plus, if he score more than $20, more than 20 goals per season, he gets another $5 million. Now the $5 million will be that contingent consideration, contingency, which if something happen, then he can get something else. That's how it should go. Now, acquisition costs are not including costs such as professional fee and cost of the issue in the shares. So everything which is related to that side, it has to be removed. That's not part of the acquisition cost. Now, let's see the net asset acquired. If we bind the net asset, so the acquirer should recognize and measure the identifiable assets and liability by the fair value and report them separately from the goodwill. We have to have identifiable assets, include those at the value of not presently recorded in the query, such as internally developed patterns. So the query can have internally developed pattern, which can be identifiable assets, which has to be recorded. Can allocate only items that meet the definition of assets and liability. That's why we need that conceptual framework. For example, I cannot allocate an expected cost of terminating the subsidiary employee to a liability of the termination, since the termination hasn't happened yet. In this case, the termination cost will be recorded of the post-acquisition expense, not at the time of the acquisition. So recognition of the goodwill. What will be the goodwill? Now, the goodwill will be the excess of the total amount that the company pay versus the fair value of identifiable assets and liability. So let's see, fair value, let's say I'm buying your laptop. Fair value of the laptop is $1,000, but I'm paying you $2,000. So the consideration is $2,000, so I'm paying you $2,000. right? I'm paying you $2,000, which is above the fair market value. So since I'm paying you over the fair market value, whatever I'm paying over the fair market value will be considered goodwill. Why is it goodwill? Because I'm seeing something in your laptop which you don't see. Maybe the information, maybe the motherboard and whatever it's inside, which you cannot see, but I'm seeing it and I'm valuing and I'm paying for that one. Can we have a negative goodwill? Yes, we can have a negative goodwill. When will be that? When the market consideration is below the fair market value. In that case, let's say the fair market value of your laptop is $1,000, but you're in a hurry, you want to get rid of it because you don't need it, you found a new one for some reason, and you're willing to sell it below the fair market value. You're selling it for $500. In that case, the other company is going to have a negative goodwill by simply purchasing something on the gain. So you have the gain on the purchase, that means negative goodwill. Now let's go with the example. Now, first example, will company offer to buy all the assets and assume all the liability of big corporation. The management of big corporation assets, the offer says the offer, accept the offer. Now assume on January 1st to year 2, company pays $95,000 in cash to the corporation B for all the net assets of that company, and there's no direct cost involved. Because of this cash is the minimum payment, company A is the acquirer. The acquisition is allocated. Now let's see what's the acquisition here. Now first what we're going to have. Let me see if this is going to flow in the Excel spreadsheet and how exactly it's going to flow in the Excel spreadsheet. Just give me a second just to try this. No, it doesn't flow the way I want it. But anyway, okay, I can use this one for the purpose later. Okay, so this one is the acquisition pay. We're paying $95,000. Why are we paying $95,000? Because we want the fair value of the assets we're acquiring is $80,000. So we're overpaying $15,000. $15,000 in this case will be the goodwill. Now the company will have to take the following journal entries. So now we're missing something here, and that missing part comes from the slides, actually from the textbook. And in order you to see the whole picture, I have to find it in the textbook. Just give me a second to go to that particular thing. And that's why at some point the slides start getting very close to the textbook and kind of implementing the information from the textbook into the slides. Let me find where exactly is this information, and we can gonna start. I'm gonna try to flip everything on the Excel spreadsheet, and we can talk about this on the Excel spreadsheet. Just give me a second here. Trying to get exactly the part of the textbook with the information about the company. I think I'm almost there. Okay, I have something here. Just let me do some adjustments, and I'm gonna try to move to the Excel spreadsheet so I can explain this one on the Excel spreadsheet so you can actually have it. I was getting mess on my screen because I have so many windows open trying to get the right things so I can get the information for you. Just give me one more second and I'll be with you.
Okay.
All right, so let's stop sharing this and let's move here to the Excel spreadsheet. Now we have those two corporations. Now we have the balance sheet for corporation 1 and we have the balance sheet for corporation B. One corporation buying the other one, right? So that's what's happening in reality. One company buys the other one. Now, what we can see here from the corporation 1 and corporation 2. So the assets here are 88,000. Liability 30,000. Common shares we have and retained earnings, which is 88. So the fair value of the asset is 109,000. Fair value of the liability is 29,000. So the fair value of the total assets is 80,000. So for that reason, since the fair value is 80,000, now the company pay cash $95,000, but they get fair value only $80,000. So they have a goodwill of the $15,000. So now we have to do the journal entry, which is the company, a company have to do the journal entry. Basically, they purchase the assets. So what they purchase? They purchase the assets of fair value of the assets, which is $109,000. Then they purchase the liability of $29,000. They pay $95,000. And after that, they have to balance the journal entry. So basically, what the company A is doing is they doing debit assets, but the assets are the fair market value, which the fair market value, as you can see, is $109,000. That's the first. Second, they're purchasing the liabilities at the fair market value, credit liabilities. Liabilities, they purchase the liability of 29,000, right? Once they do that, they pay in cash, credit cash. They paying $95,000. And that gives them that they're 124 on one side and 109 on the other side. That means they having now the goodwill. Goodwill, which is $15,000. And in that case, now I'm in balance. 24,000 here, 24,000 on the debit side, now in balance. This happened on the books of the company A. So once the company A do this, the company A currently have assets, liability, equity, retained earnings. So now what's going to happen now with the company A? Once they do that, now the company A balance sheet is going to have assets, and the assets now is going to be 300. Now that's how much they have in the beginning, 300 plus here will be 300 plus the new assets that they just acquired, 109, minus the cash that they paid. They pay in cash, which is also asset, 95,000. Make sense? That's going to be the assets. So those assets are going to come as assets, and that will be the assets. Also, they're going to have a new assets, which is goodwill. Goodwill will be, originally they didn't have any, but once they purchase it, they have now 15,000. And that's a goodwill. And that's all. Then we're going to have total assets. Then they're going to have a liability. And they originally have 120,000. But they purchased new liability for 29,000. And that's about it. Then what they're going to have? They're going to have their common shares, which not going to change. And they're going to have their retained earnings, which is also, it's going to be the original retained earnings, which was going to be 100,000 here. And the retained earnings, the original retained earnings, which is 80,000. Now, in this case, we should be in balance. Let's check and see if, in fact, we are in balance. So once we have the 300, I can easily copy this one and post this as a formula. Now, my asset's going to be $340,000. My goodwill will be equal to $15,000, the one that I just purchased. And my total assets going to be $329,000. Now let's see on the liability side. I'm going to have those two, which is going to give me 149,000. And 49,000. And then I'm going to have 100,000 common shares. And I'm going to have 80,000 retained earnings. That's going to should give me exactly the same that I have, 329,000. So as you can see, we are in balance, and that's what's happened in our books. This is when we purchase the net assets. Again, we are recording the net assets at the fair value. What's the original value? We don't care. We're just taking the fair value and we're putting those one in our books. And that's how we are done with this. Make sense? Any questions so far?
No, it makes sense. Thank you.
Okay, so now we have to move to the next part. The next part is that now we have to chase. Let's see, let's move to the slides. Let's go back to the slides. Let me see where I left the slides. So again, we purchased those for 95,000. So now we have the purchase of the acquisition 95, fair value. Now we know from where the fair value comes 80,000. And we have the difference of the goodwill, and then we start combining. The journal entry is we get the asset 109,000. We got the liability 29. We pay the cash 95, and that creates a difference of 15,000, which is our goodwill. And when we have to prepare the balance sheet on the time of the acquisition, when we purchase it, our assets will be 340,000, goodwill will be 15,000, and the liability 149, common shares 100, and retainer is 80,000, and we're getting the balance. This is the first scenario when we purchase the net assets. Second scenario, we're still going to purchase the net assets, but now we're going to issue shares. Now, once we issue the shares, common shares, we issue the shares of the market value 23.75 per share to the B corporation as a payment for the company net assets. B corporation then will be stop existing after the sale of the net assets. Because this method of payment is shares, then we have to do the following analysis. Company X now hold 5,000 shares. Company Y will hold on the one up 4,000 shares. Total shares will be 9,000. Company X, then we're going to hold 56% of the company A of the 9,000 shares. So that means company X becomes the acquirer of the company B in this case. If that's happened, then what we have to do? We have to calculate the goodwill first. Now, the goodwill is not going to change because in this case, acquisition cost, we issuing shares, which shares value is $95,000. And we're giving them shares for $95,000. The net assets are still going to be same, 80,000, 129 minus 29, 109 minus 29, $80,000. Goodwill still going to be 15,000. However, now we have to pay the cash for the issue of the shares. So the other company is going to pay the cash for the shares, right? Assets are going to be 109, goodwill will be 95, liability 29, cash will be 95. Now, what's going to happen now with the balance sheet of the A company? Since the A company in this case, they don't pay cash, they issuing shares. Actually, that shouldn't be cash here, that should be shares here. So in this case, they issue shares, common shares. They're not paying with the cash, they issue common shares. Of 95. So for that reason, now what's going to happen is the assets going to increase with with 109, and since we're not paying cash, then the cash not going to be reduced. So the new assets going to be $409,000. Goodwill is a goodwill. That's not going to stay. Liability is going to stay the same, but the common shares now it's going to go up. Why? Because we just issue common shares for $95,000. And the retainer is going to stay the same. So that's how we're going to balance the entry. So as you can see in the second case, our assets are higher with the purchase price, but the common shares take the increase in this case. Now, consolidated financial statements. When the investee acquires a sufficient voting share to obtain control over the investor, over the investee, then we're going to have parent-subsidiary relationship. Parent is the one that invests in the investor. Subsidiary is the investee. Whoever pays and have the control, he's the parent. Whoever is under control, he's the subsidiary. Usually, the company involved continued as a separate. So basically, when this happens, when we have a business combination, when they have a parent obtain control over the subsidiary, the subsidiary can still exist as an entity. The parent is going to exist as an entity. But those company now is gonna operate as one family of the companies. They're all going to have the separate financial statements. They have to prepare the separate financial statements, but they're going to stay together. They have to report together. Now, the consolidated statements going to include balance sheet, statement of the comprehensive income, statement of changes of equity, and cash flow statement. International Financial Reporting Standard 10 explains those ones. So what's the consolidated financial statement? Those are the financial statement of the group of which assets, liability, equity, income, expenses of the parent and subsidiary are combined and presented as a single entity. So how you can picture this? The parent itself is going to prepare the financial statements. Subsidiary itself is going to prepare the financial statements. All together, it's going to exist. So then, where we're going to make that consolidated statement? Consolidated statement will be prepared somewhere aside. So the subsidiary going to have their software, accounting software, which they're going to do the financial statement. Parent can have a different software which doing the financial statements. Then consolidation is going to happen on a separate computer which has nothing to do with the parent and subsidiary. But he's going to use those ones. Now the group of the parents, the group is the parent of the parent of subsidiary. Parent is the entity who have the control over one or more entities. Subsidiary is the one who is controlled by another entity. Non-controlling interest, that will be interesting thing. Non-controlling is the portion of the entity which parent have no control. So state that the parent, so the next thing, parent is itself a wholly owned subsidiary or partially owned subsidiary. Parent's debt or equity instruments are not publicly traded. This is when this paragraph states that the parent is not required to present consolidated statements. So in which cases we don't have to do consolidated statements? When the parent itself is the wholly owned subsidiary. So if the parent owns subsidiary, but the parent is owned by another parent, is subsidiary of another parent, then you don't have to prepare the consolidation. Second one, if my shares, parent debt, and equity instruments are not publicly traded, I don't have to prepare consolidation. Parent has not or will not filing financial with the regulators for the purpose of issuing debt or equity instruments on the publicly traded market. So if I'm not planning to trade my shares on the market, I don't have to prepare consolidation. And the ultimate or intermediate parent of the parent produces international financial compliance consolidated financial statement for the public uses. So this will be another instance where I don't have to prepare consolidated statements. If the parent meets the consolidation, so if that consolidation requirement is met, then we have to follow some rules. Then we have to prepare a separate financial statement which account for the investment in subsidiary we have at cost in accordance with International Financial Reporting Standard 9 or using the equity method as described in the International Accounting Standard 28. So we have a lot of options here, which doesn't make it any easy for us, but we're gonna see all those ones. Let's see first one, purchase of shares. Now assume that the company A pays 95,000 cash to the shareholders of corporation B for all the shares. Now, in this case, since this is transaction between company buying shares directly from the shareholders, that will be interesting. The financial statement of big corporation have not been affected at this transaction. Why? Because the shareholders get the money. The company doesn't get anything. What's going to happen in this case? If we have to prepare this calculation. Now, this calculation is very universal. And I'm going to show it to you because we have to do this over and over and over again. So let me copy this and flip it on the Excel spreadsheet. And I'm going to start recreating this one on the Excel spreadsheet so you can see the whole thing here. Actually, it works. I don't have to recreate it. It's just pasted and it works for me. Just give me a second to do some formatting and I'm going to show it to you. Okay, so what we have here. Company pay cash to company A. By company A, they pay $95,000. For what they paying $95,000? Because the corporation, as you remember from the previous slides, so here, let's flip it here so you can actually see it. So what they're paying is they're paying assets for $88,000 and they're paying for the liability, which is $30,000. Those two together, asset minus liability, is going to give you the net book assets. Remember, this is the net book assets. And this is 30,000. They're paying for the net book assets. Then they have the acquisition differential, which is equal to the purchase price or consideration paid minus the net book assets. Let's make it numbers so we can accept our calculation. That will be 95 here. So we have the acquisition differential at this point. How the acquisition differential is allocated? Well, it's going to allocate it between the fair value and the carrying amount, or carrying amount in this case will be the book value. So we have the fair value of 109,000, but our book value was 88. So 21,000 is the difference, increase in our assets. For the liability, on liability, original liability is 30,000, but the fair value is 29. So we have decrease in liability with 1,000. All those two together, it's going to give us $22,000. And that will be increase over the book value. So basically our goodwill in this case will be only the acquisition differential minus the fair value increase, only $15,000. That will be our goodwill. Make sense?
Why at the end we have $15,000?
Which one?
Was the end of the formula. The 15, yeah.
This one, 15,000?
Yeah.
Again, so we're paying 95.
Yeah.
We're paying 95. Now their assets are 88. On their books, they have $88,000 assets,
Yeah.
right?
Mhm.
The $88,000 assets. Their liability is 30,000.
Yeah.
Right? So in total, we're paying for $58,000. So that means we're paying more, $37,000. At this point, we're paying we have acquisition differential $37,000. Now, the next thing, but we're not chasing the book value, we're chasing the fair value. So the fair value of the assets is 109. So 109 minus 88, so the assets actually increase with $21,000. Make sense?
Mm-hmm.
And the liability decreased from 30, the liability is only 29.
Mm-hmm.
So that's also positive for us. So out of those 37, 22 is something that we indirectly getting through the increase of the fair value of the assets and decrease in the fair value of the liabilities. So basically, we overpaying only $15,000.
Yeah.
Make sense?
Yeah, it makes sense.
Okay.
But
Yes.
then this $50,000
That will be our goodwill now.
would work?
That will be goodwill.
Okay.
Right?
Why is not income? Like
Because
other
because income comes from the operation of the company. Here we purchase another company. It cannot be income. In this case, if we pay something more than what we're getting, especially when we're acquiring business, that's called goodwill.
Okay.
And in this case, it's not income because you're paying more than what you're getting,
Oh, yeah.
right? In
But
this case, technically you're losing money, right?
yeah.
But it's you cannot call it loss, but call it goodwill. That's why you're reporting on the balance sheet as a debit.
And when is it could be a loss?
We're gonna come to this just a second, and
Okay.
we're gonna come to that, to the opposite scenario,
Okay.
right? So let's go now back to the slides. So the next thing that we have to do is this crazy Excel spreadsheet. So let me grab this one Excel spreadsheet and let's explain that Excel spreadsheet as well. Which totally makes sense. But in order to understand it, I have to explain it and then it will be easy for you to process it. Just a second to do some modification here and I'm going to show it to you. Okay, so let me share my screen now. So what's happened in this situation? First thing that happened is if you have to take only the original information, right? And our original information, we have this company, which is company A. And then we have the company B, which we're purchasing. Correct? So now the company A purchased company B. Make sense? So what's happened in the company A in the very beginning? Now they have assets $300,000. They have liability 120. They have common shares and retaining 80, total 300,000. But now they purchasing company B for $95,000. So that means they have investment, correct? Are you guys with me? One asset is replaced with another asset. Now they have investment. Make sense?
Yes.
So the total assets are still 300,000. There's no questions about it. The assets are 300,000. That's 95,000. 300,000. Those common shares are 100,000. And retained earnings is 80,000. I have to enter those one because otherwise they're not going to flip. So what the other company has, they have assets for $88,000. They have liability $30,000. They have common shares of $25,000. And they have retained earnings of 33,000. So in the first entry, if we have, there are two entries here. Entry number 1 and entry number 2. In the first entry, what we're doing is we're purchasing something. What we purchase? We pay $95,000, if you remember, the very first entry. Let's go with this one here. I'm going to paste it here. We're paying $95,000. Make sense? Are you guys with me?
Yeah.
So why are we paying the $95,000? Because the company have assets and liability. But the total assets and liability is 58, correct?
See, yeah.
Now the assets and liability presents the net assets. But the net assets are equity. How much is the equity of the company? 25 and 33?
25, yeah.
How much is that?
88.
58. Make sense?
58?
58.
Oh, yeah.
25 and 33, 58.
Yeah.
Which is exactly liability, assets minus liability, correct? But now I'm paying, so I'm paying for the net assets, but indirectly I'm paying for the common shares. And I'm paying for the retained earnings of the other company, indirectly. So the common shares are 25,000. Retained earnings are 33,000. And as you remember, we're paying the acquisition differential 37. Make sense?
Yeah.
We're paying that acquisition differential. Which is $37,000. So now that's going to balance our entry. So we're going to have here 95 and here paying cash 95. Now the next thing is I cannot have an acquisition differential as an account. So I have to get rid of that acquisition differential. Acquisition differential. So I have to get rid of that. 37. Where the 37 is going to be allocated? Well, 21 is going to go to the assets. 1 is going to go to the liability. And 15 is going to go to the goodwill. Make sense? So if I increase my assets with, how much was that? 21,000. If I decrease my liability with 1,000. And if I add one goodwill of 15,000, that's gonna eliminate the acquisition differential, right? I'm gonna have 37 here and acquisition differential 37 here. Make sense? But this cash, I already have it as an investment. So that will be my investment here. So what we have to do? We just have to follow those entries and show it on our spreadsheet. So I'm gonna move those one down. I'm gonna erase those lines here. And we're gonna start working on our Excel spreadsheet. So our assets are 205, correct? Our company A assets are 2,500. Make sense? Their company is 88. Let's eliminate those one. And we're gonna come up with those one ourselves. And this one always gonna be equal to beginning, mine, plus theirs, plus debit, minus credit. So at this point, those will be the numbers that I'm gonna have. So let's go one after another. Our investments to investment. From the first entry, what's happened with the first entry? First entry, we eliminating their common shares. So the common shares will be 25. We eliminating the common shares. So basically their common shares gonna become 0. That will be on the credit side. So since this is on the credit side, I have to be careful here with the formula. On the liabilities, I have to switch the formula. Is going to be equal to liability plus my liability plus their liability plus credit minus debit since I'm on the liability side. Zero here, and let's move 0 here. That will be 33, 1, 2, 3. Is that going to save my problem? Here we go. Now I'm good. So the next thing that I'm doing is I'm eliminating the retained earnings. 1, 2, 3, 33. And that's gonna be here. I'm gonna create that acquisition differential for the time being, which is 37,000. That will be on the debit side. And all those three things, it's gonna eliminate my investment. Make sense? Are you guys with me?
Yeah, I'm following your numbers, but
The logic,
a little yeah,
you don't get the logic. So
yeah.
first thing first, how much we paid? We paid 95, correct?
95, yeah.
95, that's our investment. So we have it as investment. But that investment, from that investment, we have 88 assets and 30 liabilities, correct?
Yeah, this is the book value.
This is the book value. With all 88 minus 30 is 58.
Mm-hmm.
which is equal to the common shares. So technically, we're buying the common shares and retained earnings.
Mm-hmm.
And we're paying 37,000 in excess,
Yeah.
right? So that's what we're doing. 95,000 is our investment.
Mm-hmm.
37 is the excess acquisition differential that we're paying over the assets and liability, and we're eliminating the common shares and the retained earnings. Why? Because we're getting the assets and we're getting the liabilities on our statement. Make sense?
We eliminate common share and return earnings.
Retained earnings. Why? Because those two are
Yeah.
equal to the 88 minus 30,
Yeah. Mm-hmm.
right? So we eliminate, that was the first one. Second one, now we have to eliminate this acquisition differential because I cannot have acquisition differential on my balance sheet. So I'm going to get rid of it, 37, 1, 2, 3. But that means I have to increase something on the debit side. What I'm going to increase? The difference between the fair value and the book value of the company that I purchased on the assets, 21,000 are related to the assets. Make sense?
No. 21 is what? So, yeah.
21 is the fair value minus the book value of the assets of the company that I purchased,
Yeah.
right? 1,000 is related to the
Liabilities.
liability, which is going down.
Mhm.
So the liability is going down with 1,000. And the last thing is the goodwill that I just purchased, right?
Mhm.
And that's going to keep me in balance. So this one will be here 0 and this one will be 0 in order this one to work. So my total assets in this case, let's get rid of this. My total assets are going to be 329. My total liability is going to be, should be the same, 329. Make sense? So that's how I consolidated my books and the other company books into one set of books. In reality, my assets plus their assets plus the increase in the fair value of the assets is going to give me the total assets. Make sense?
Mm-hmm.
Now, the 95,000 investment is this company. But since I'm putting this company on my sheets, this statement, this investment, it doesn't have to appear because that's the same thing because I'm adding those assets. Right? The goodwill is the difference that it's over. I'm paying over the $95,000 investment. That's a goodwill. And that's giving me my total assets on the consolidated sheet. On the liability, I'm going to have my liability plus their liability minus the reduction of the liability and the fair value is going to give me the new liability. Now, since everything happened on the parent statement, common shares only on the parent exist, retained earnings is retained earnings. Those two common shares are the retained earnings of the subsidiary. They're already indirectly shown in the increase of the assets, increasing the liability, and we're done. Does that make sense?
Yes. Yeah. I forgot.
So technically, we're doing all these things. Payment of the company, 95. We're paying 88 and 30, which is 58. 58 we pay. And we have acquisition differential 37. Then we're allocating those 37 to assets and liability and goodwill. And we eliminating that acquisition differential. That's where the acquisition 37 goes. They're going to the assets, liability, and the goodwill.
Okay.
Okay, so now let's go back to the slides and see, is there any other way we can do this? So again, what we're doing is the company be balanced. This is step by step, one after another. If you want to follow this one, the one that we just did. So now, let's go with the purchase of the net assets. What's going to happen if you purchase the net assets with the shares? Now we assume that the company issue 4,000 common shares at the fair value of 23, the second example that we have. So in that case, what's going to happen is, now the same thing, but the only difference this case will be that our common shares is going to already increase with 95, right? We're still going to eliminate everything that we did, that I just show you, but our common shares increase with 95. That will be the only thing. So we're not using the cash to pay for the investment. We're using the common shares to pay for the investment. That will be the only difference. Everything else is going to be the same.
The common shares, okay.
Right? So, in that case, we can, this is the indirect approach, or this is also called the working paper approach. There's another approach, which is direct approach. How will be the direct approach? That will be alternative to the worksheet method approach. Then will be the carrying amount of the parent plus the carrying amount of subsidiary plus minus acquisition differential. It's going to give you the consolidated amount. So what's going to happen here? Direct approach is simple. Same thing like the other one, but just on one sheet you're doing it. We're going to get the assets. Our assets 300 plus their assets plus the increase in the fair value of their assets. It's going to give us new assets. My goodwill was 0. Their goodwill was 0. I just purchased the goodwill 15,000. That will be the goodwill. On the liability, my liability was 120. Their liability was 30. But their liability decreased with 1,000. So the total liability 149. Common shares is the common shares that we issue, 95, 195. And the retained earnings is 80. That will be the direct approach. As you can see, direct approach is similar to the worksheet, but we're eliminating all those middle things. We don't have this debit and credit. We're just showing everything that stays here. As you can see, we're looking for the point of view of the parent. For that reason, the common shares in the retained earnings subsidiary doesn't appear on the consolidated balance sheet. Why? Because already been assumed by the parent. So reverse takeover. Once we purchase the subsidiary, can the subsidiary take it over? Yes, they can. How will be that? When one company obtains ownership of the shares for another, issuing enough voting shares, also that control of combined then passes to the shareholders of the acquired enterprises. The reverse takeovers then consolidated sheet if the reverse takeover, the consolidated balance sheet, which incorporate the carrying amount of the net assets of the deemed parent or legal subsidiary and the fair value of the deemed subsidiary, and then we're not going to have any more the consolidated statement. We don't have to do the consolidation. How are we going to report the depreciable assets? For the depreciable assets, there are two methods. One is the proportional method. The other one will be the net method. In this course, we're going to use only the net method. But
Net?
both net
Net?
method. Net
Okay.
method, yes, net method, which is the original cost minus the accumulated depreciation.
Okay.
Right? And what's going to happen with the other consolidated financial statement of the year consolidation? Then consolidated net income, retained earnings, and cash flow will include subsidiary income and cash flow only on the subsequent to the date of acquisition. So on the date of acquisition, we're gonna just show the balance sheet. There will be no income, no cash flow, nothing like that, because the time hasn't passed yet. Once the time pass at the end of the first year, then we're gonna prepare those ones. Disclosure requirements, very extensive disclosure when we have a business combination. That will be the name of in the description of query, acquisition date, percentage of the voting shares, primary, why we doing this combination, qualitative description, acquisition date of what's the fair value at the acquisition date, how we come up with that fair value. Why is this happen? Because we might have push down accounting, which push down accounting is not permitted. What means is we purposely on the date of acquisition pushing down the fair market values. We creating, but pushing down the fair market value, what we can do, we can create a high goodwill. But that's not permitted. And what is the new equity method? That's the alternative to acquisition method. That's not gonna spend time on this. One, we're gonna spend one we're doing the analysis interpretation of financial statement. Now the separate entity financial statement of the parent and subsidiary, they're presenting the financial statement itself. Once we consolidate it, the investment account is replaced by the underlying assets and liability. As you saw, once we combine the both sets, I cannot keep on the set investment. Why? Because that investment, it flows into the total consolidated statement. So the investment will disappear and it's going to be replaced by the assets and liability and goodwill. So basically, once we do that, that's going to give you the same result as the investor had bought a subsidiary, assets and liability directly. That's why we adding the assets and liability, we eliminating the common shares and retained earnings, adding the goodwill, and eliminating the investment. And then preparing the set that's sitting there. The difference between the accounting standards and the international financial reporting standards is the enterprise shall make the acquisition accounting policy choice, either consolidated its subsidiaries or report the subsidiary using either equity method or the cost method. That will be the difference between the international financial reporting standard and accounting standard for the private enterprises. So this is the scenario when we purchase 100% of the other company. Now let's see what's going to happen if we don't purchase 100%. Means when we have a non-controlling interest.